Welcome to The Explainer. Today, we are cracking open one of the most legendary investing books out there, Seth Klarman's Margin of Safety. This book is basically a masterclass in smart, risk-averse thinking, and we're going to break down all the core lessons for you right here. So let's jump in. Right off the bat, Klarman asks this huge question that kind of makes you rethink everything you thought you knew about the market. He argues that a lot of people aren't actually investing at all. They're speculating, and they might not even know they're doing it. And, that difference is the key to everything else we're about to talk about. So, okay, let's start with the problem he lays out. He paints this picture of Wall Street not as some disciplined place for smart investments, but more like a giant, high-stakes casino that's basically designed to trick you into making some really dangerous bets with your money. To get this idea across, Klarman uses this amazing, kind of brutal phrase, yield pigs. That's his term for people who get so laser-focused on getting a high return right now that they completely ignore the massive risks they're taking on. They're just chasing that big, immediate payout, totally blind to the fact they could lose a whole lot of money tomorrow. And this is exactly how the casino sets up its games. I mean, he points to stuff from the 80s, like Ginnie Mae's, which were sold as having this amazing yield. But really, a big chunk of that yield was just Wall Street handing you your own money back and calling it a profit. Or you had these option income funds, where you'd get a little extra cash today, but in return, you gave up any chance of a big win later, while still keeping all the risk if things went bad. The point is, the packaging looks tempting, but what's inside can be real poison. Klarman also has this great warning about fads. The market gets totally swept up in some hot new thing. Could be anything. And suddenly it starts valuing this unproven, trendy idea like it's a timeless, bulletproof business like Coca-Cola. And what happens? Investors end up paying a permanent price for something that was just, a temporary craze. So, if Wall Street is a casino, why is it so tough to win? Well, Klarman's answer is pretty straightforward. The rules are rigged. Not always specifically against you, but they're always rigged in favor of the house. And this right here is the fundamental problem. It's a huge conflict of interest. Think about it. Wall Street makes its money from activity, from you buying and selling. Their goal is to keep you trading, but your goal is to patiently let your capital grow. They're always going to be optimistic because optimism sells. You need to be a realist. Your goals and their goals, they're just not the same. He uses this brilliant analogy about Roman engineers to really hammer this point home. You see, that engineer had real skin in the game. His life was literally on the line, depending on the quality of his work. But Klarman says a lot of money managers today, they don't eat their own cooking. They're not investing their own cash right alongside yours. So if the whole thing comes crashing down, you're the one who gets hurt, while they just walk away with the fees they've already collected. And all of this creates a system that just has this built-in bias towards going up. I mean, you almost never see an analyst put out a sell rating, right? Because it doesn't make anyone money, and it really ticks off their corporate clients. Even the market's safety nets, like circuit breakers, they're designed to stop panic selling, but there's nothing like that to stop panic buying. It's a system that makes it way too easy for things to get dangerously overpriced. Okay, so that's the problem. And yeah, it sounds pretty bleak. But here's the good news. Klarman doesn't just describe the sickness, he gives us the cure. And it's this entire philosophy called value investing. You can think of it as your personal shield against all the chaos in that casino. Now, this is absolutely crucial. So many people are looking for some secret formula, some magic trick to get rich. Klarman is crystal clear. This is not a formula. It's a mindset. It's a disciplined, business-like way of approaching the market. And the heart of that mindset is this simple but incredibly deep rule made famous by Warren Buffett. Your number one job isn't to make money, it's to not lose money. Why? Because avoiding a huge loss is the single most important thing you can do for your long-term success. The math here is so powerful, you have to see it. Take investor A. For 9 years, they look like a genius, making 20% a year. But then, boom, one bad year, a 15% loss. And where do they end up? In the exact same place as investor B, who was just steadily making 16% all along. It proves that consistency and just avoiding those big wipeouts is what wins the game over time. So how do you avoid losing? The entire philosophy really just boils down to these 3 simple words: margin of safety. This is the big idea, the absolute bedrock of value investing, first taught by the great Benjamin Graham. Okay, margin of safety sounds great, doesn't it? But what does it actually mean? Like, how do you actually do it?
Let's get into the nuts and bolts. The whole idea is actually incredibly simple. You never, ever pay full price. The goal is to buy $1 worth of something for way less than $1. Why? Because the future is a mystery. Your analysis could be wrong. Things can go wrong. Bad luck happens. That discount is your buffer. It's your cushion.
So here's how it works. First, you do your homework. You do the hard work of figuring out what a business is actually fundamentally worth. Let's just say, for this example, you figure out it's worth $1 a share. Okay, now for the hardest part, being patient. You don't buy at 95 cents. You don't even buy at 80. You wait. You wait until the market gets scared or just plain silly and offers you that business for a huge discount, maybe 50 cents. And that gap, that 50 cents between what the thing is worth and what you actually paid for it, that is your margin of safety. That's the whole game. That's the cushion that protects you. So if you were a little bit wrong about the value, it's okay. If the business hits a speed bump, you're protected. And Klarman adds a really important layer here. He says that your margin of safety is way, way stronger when it's backed by hard, tangible assets. Stuff you can actually touch. A company's real estate still has value even if the company fails. But a brand name, that can vanish in a puff of smoke if trends change. So at the end of the day, all of these ideas, the casino, the rigged rules, the margin of safety, they all lead us to this final fundamental choice that every single one of us has to make with our capital. And this brings us right back to the beginning. Are you an investor or are you a speculator? The investor looks at a stock like they're buying a piece of a real business. They care about its value, its cash flow. The speculator, on the other hand, sees a stock as just a piece of paper, something they're hoping to sell to someone else, the greater fool, for more money later. They don't care about value. They only care about which way the price is going to move. And it all comes down to this one simple, powerful question. The next time you think about buying anything in the market, just stop and ask yourself, am I focused on the value of what I'm getting, or am I focused on the price I hope someone else will pay? Your honest answer to that question will tell you everything you need to know about whether you're playing the long game of an investor or just taking another spin at the casino's roulette wheel.